In this video, I'm going to demonstrate calculating cost of goods sold and also an income statement for a manufacturer and show you the different caveats compared to a merchandiser. And I'm going to use exercise 262 as a demonstration for this. Now, before we jump into the problem, because it's going to feel probably overwhelming, lots of different numbers, lots of different calculations. There was a template I shared under the chapter 1 and 2 guide that I think helps explain the different steps involved. So if you haven't checked that out, maybe pause the video and go ahead and download that because you might want to make notes with it as we go along. And again, ultimately for a manufacturer, I want to calculate cost of goods sold, but it's a much more complicated calculation than a merchandiser. And I've tried with different colors to break this down into the three major steps involved that relate to the three different categories of inventory for a manufacturer. That's direct materials. You might have known it otherwise as raw materials. Raw materials are items of inventory purchased from suppliers, but they haven't been yet used in the manufacturing process. Direct materials is a subset of that. It's integral materials that we can trace directly to the manufacturing process compared to indirect materials. My second part of the process then is here in green. That's work in process. So I begin to put together those direct materials, added in direct labor, added in manufacturing overhead. I'm just not done with the items yet. And then finally, we have finished goods when I've completed those manufactured items and they're ready for sale. Once they're sold, they finally become the expense cost of goods sold. Again, this still probably seems a bit overwhelming. You probably remember back in your intro to financial accounting days, or even if you've done your intermediate financial accounting classes, the basic formula for a merchandiser to calculate cost of goods sold was a heck of a lot easier. So you started with beginning finished goods inventory. You added in purchases because you're a merchandiser. You just buy the finished goods and resell them. You subtract out your ending finished goods inventory balance and you can calculate cost of goods sold. And again, one other thing you might remember from those days is beginning finished goods plus purchases is what we call inventory available. So what I start with plus what I added in and bought is what I have available. If I subtract out what I ended with, then I back into what I took out, and that's called cost of goods sold. Now, for three different categories of inventory for a manufacturer, we just need to generalize this formula you should already be familiar with. Instead of calling it beginning finished goods inventory, let's just call it beginning inventory. Instead of calling it purchases, because not all of those three categories of inventory relate to purchases, let's just call it additions. Instead of ending finished goods inventory, ending inventory. And again, instead of cost of goods sold, which was just simply a withdrawal to finished goods and being sold, let's just generalize it to withdrawals, uses, subtractions. Okay, I promise this will make sense as we go along. I also want to look at just a general inventory account. And again, I can relate this to direct materials, work in process, or finished goods. If you recall, inventory is an asset, so the beginning inventory balance would be on my debit or my left-hand side. Any additions also would be on my left-hand side. Any withdrawals or items I'm taking out of that inventory would be on the right-hand side or the credit side. And I would expect, I can't withdraw more than I started with or added in, that my ending inventory balance would also be on the debit or left-hand side. If I didn't know what that subtraction or credit or withdrawal was on the right-hand side, again, if I take the beginning inventory plus any additions and subtract out the ending inventory balance, I can back into that credit or the withdrawals. Now, I can take that general account and again relate it to the different categories of inventory, and I'm going to go in sequence. I'm going to start with the most basic type, my direct materials. So I purchase them from the supplier and I have not yet used them yet. Keep in mind, beginning direct materials, I purchase them. So I'd add in the purchases. If I didn't know what the credit or withdrawal side was, if I simply subtract out the ending inventory balance, I get what I'm going to remove from direct materials inventory. Where do I put it? I add it into work in process inventory. So work in process inventory, I start with beginning balance of work in process inventory. Direct materials is just one of three types of manufacturing costs that I'm going to add in. Keep in mind, I'm also going to add in direct material, or excuse me, direct labor and manufacturing overhead. If I add those to the beginning inventory balance, if I don't know, again, the credit or withdrawal side, and I'm trying to solve for that, if I subtract out the ending inventory balance from my beginning and my additions, I get my subtractions or withdrawals on the right-hand side from work in process inventory. Now, in accounting, we always have to have special names to make it extra confusing. And we're going to give this a special name called cost of goods manufactured. That simply is just all the material, labor, and overhead related to items that were completed during this particular period and added into finished goods. Now, I promise we're getting there. We're almost to the point that we're going to jump into the problem. Finished good. Beginning balance. Now it's not adding in purchases, it's adding in the cost of good manufactured, or again, the cost transferred from work in process to finished goods. Again, if I don't know what the right-hand side is, which is the withdrawals or cost of goods sold, I simply subtract out the ending inventory balance and I can back into cost of goods sold. Again, hopefully this is a helpful template to help solidify this concept. So finally, I said we'd eventually get there. Let's go ahead and jump into the problem. Again, lots of different numbers swimming on the page, but again, let's focus on our three major steps to calculate cost of goods sold, and let's start with our direct materials. Now let me grab my highlighter to get a close color to relate these. Remember, we're going to start with the beginning balance of direct materials, which here in this example is going to be $96. To that, we add the additions, which is material purchases. I'm going to go down here on the list. The material purchases for this particular year is 10,300. Add that to the beginning balance, I get direct materials I have available to use. If I subtract out the ending inventory balance, which is going to be December 31st of 2000, it's going to give me, and that's $110, it's going to give me the amount of direct materials that were taken out or used or added into work in process, which is 10,286. Let me get rid of my highlighter here real quick. So what's the next step? What's the next category of inventory we have to deal with? That's going to be work in process. Okay, so let me add this in. Now, I'll add a caveat, and I want to follow exactly the template from the book, because if you're filling stuff in Connect, you want to fill that template. I'm not sure why they decided to add the beginning inventory balance for work in process above direct materials, but again, I'm just going to go ahead and flow with that. Again, let me grab my highlighter to get a color that's pretty close to this. I'm starting with my beginning work in process balance here, January 1st, which is 152. I'm going to skip the additions for now and come back to that. Eventually, I'm going to subtract out the ending work in process balance at December 31st, which is $136. But I need to add in any additions. If you recall, the additions, the three major forms of cost, are direct materials, which we already calculated as 10,286, direct labor, which we're given as 13,000, and also manufacturing overhead. Well, they don't give us manufacturing overhead directly here, but they give us some different categories of costs that fit within manufacturing overhead. Remember, manufacturing overhead is any other manufacturing cost that's indirect. So things like indirect materials, indirect labor, and any other cost related to manufacturing that is not direct. So I'm going to go through my list here. That does not include administrative. It does include depreciation related to the factory. So I'm assuming that's depreciation. We own the building. That's the depreciation on the building. Depreciation on machines used in the manufacturing process. Remember, we've already captured direct labor. That's not indirect. We've already captured material purchases. Indirect labor would definitely be included in manufacturing overhead. Indirect materials, so they are raw materials used in the manufacturing process, but we can't easily trace them. Property taxes only because it's related to the factory, not selling costs. Those are not manufacturing costs, not sales revenue, but utilities because, again, they're related to the manufacturing process. Those categories I highlighted here to my left-hand side are all going to be manufacturing overhead. So again, lots of numbers that I added to the page. Once I add up all the manufacturing overhead costs, that is $20,530. I add that to my other manufacturing costs of direct materials of $10,286 and direct labor of $13,000, and I get total manufacturing costs just added into work in process of $43,816. Finally, I know it's way far up here. When I add it to the beginning balance of work in process of 152, I get total cost available in work in process of $43,968. When I subtract out the ending balance in work in process of 136, I get what is withdrawn from work in process and taken to finished goods, which is called cost of goods manufactured, and that is 43,832. Hang on, we are definitely in the home stretch, so bear with me here. What's our last category of inventory? And that is finished goods. Again, let me change up my highlighter here. Recall that's going to be the beginning balance of finished goods, $1,974 here. Add to that what was taken out of work in process and added into finished goods. That's called cost of goods manufactured of $43,832. That gives me what would be available in finished goods to sell, not necessarily what I sold, but $45,806. If I subtract from that what's left in finished goods, which is $2,026, I finally get what I took out of finished goods, or the expense called cost of goods sold, which is $43,780. Okay, quick pause here. You might want to pause the video just to reflect and make sure you can follow all those steps. Now, moving on, last step again, promise we're in the home stretch. I need to prepare an income statement. So, any income statement, whether it be a merchandiser, whether it be a manufacturer, service company, is going to start with revenue or sales. So, I'm going to start with 60,220 here, my sales revenue. If I'm doing a manufacturer, typically I'll do what's called a multi-step income statement, and I'll separate out those expenses into different categories instead of just subtracting them in one step. And I'll first subtract cost of goods sold, which again we calculated in our prior step as 43,780, and I get a rough profitability measure called gross margin. Now, that's not the same thing as net income. I haven't subtracted other expenses from that, but just a quick and dirty profitability measure of here's my revenue versus what it costs in terms of product costs related to that. And so my gross margin is 16,440. What's left to subtract? Again, I'm not finished. I need to subtract out any selling and administrative costs, and you can find those here. Selling costs of 2,140 and administrative costs of 4,200. Now you notice I left blanks because I'm not trying to give it all away to fill it all in for you, but just as a check figure, once you add up those selling administrative, subtract it from the gross margin of 16,440, you get an operating profit of 10,100. Now, I know this has been a long video, but hopefully it helps work you through the process.